Question 1. Which of the following options best describes the key risk factors associated with indexed annuities? A. Indexed annuities are at risk of market volatility but provide a guaranteed fixed minimum interest rate, regardless of market performance. B. Indexed annuities bear high liquidity risk due to early surrender charges, especially if the annuitant decides to withdraw within the first 10 years. C. Indexed annuities are exposed to inflation risk due to fixed payment structures that do not adjust with inflation over time. D. Indexed annuities carry no market risk because they only follow the stock market indirectly without any downside exposure. Answer: B. Explanation. Option B is correct because indexed annuities often have high liquidity risk due to significant surrender charges if the policyholder withdraws funds early, usually within the initial period, often 10 years. These surrender charges can be steep and make the annuity less flexible for early withdrawals. Option A is incorrect. Although indexed annuities can offer a minimum interest rate, they are not directly exposed to market volatility. Instead, their returns are tied to a market index, which indirectly influences their earnings. Option C is misleading. While inflation risk may impact annuities, indexed annuities can benefit from index-linked growth, which may counteract some inflation effects. Option D is incorrect. Although indexed annuities limit downside exposure due to interest crediting strategies, they still may not earn interest if the index performance is low, presenting an indirect market-related risk. Question 2. Mr. Thompson, age 62, has a non-qualified annuity and needs to make a partial withdrawal to cover unexpected medical expenses. Which of the following statements accurately describes the tax implications of his withdrawal? A. Since Mr. Thompson is over 591, where his withdrawal is tax-free as it is for medical expenses. B. His withdrawal will be taxed only on the principal portion, as this part has already been taxed. C. The withdrawal will be subject to ordinary income tax on the earnings portion of the annuity, while the principal amount will remain tax-free. D. Since it's a non-qualified annuity, there is no tax implication as these types of annuities are funded with after-tax dollars. Answer: C. Explanation. Option C is correct. For non-qualified annuities, withdrawals are taxed on a last-in-first-out LIFO basis. This means the earnings portion, which grows tax-deferred, will be taxed as ordinary income upon withdrawal. Since Mr. Thompson is over age 591, where he avoids the 10% early withdrawal penalty, but he still owes income tax on the earnings. Option A is incorrect because the withdrawal is taxable on earnings even if it's used for medical expenses, except in certain cases under qualified health savings or medical expense deductions. Option B is incorrect, as only the earnings portion, not the principal, is subject to income tax on withdrawal. The principal was funded with after-tax dollars. Option D is incorrect. Although non-qualified annuities are funded with after-tax dollars, only the principal portion is tax-free. Earnings are taxed upon withdrawal as ordinary income. Question 3, scenario-based. Sarah, a financial advisor, has a new client, Mr. Anderson, who is 70 years old and recently retired. Mr. Anderson is looking for a steady income stream and is considering converting his accumulated deferred annuity into a life annuity with a period certain. He wants to ensure that his spouse will receive income if he passes away shortly after the conversion. Which annuity payment option would be best for his goals? A. Life annuity with no period certain, providing income only for Mr. Anderson's lifetime. B. Life annuity with a 10-year period certain, ensuring income for at least 10 years to his spouse if he dies within that time frame. C. Joint and survivor annuity, providing lifetime income to both Mr. Anderson and his spouse with payments reducing after his death. D. Lump sum payout, giving Mr. Anderson full control over his funds immediately. Answer: B. Explanation. Option B is correct. A life annuity with a period certainty. G. 10 years provides income to Mr. Anderson for his lifetime. If he passes away within the 10-year period, payments will continue to his spouse or beneficiary for the remainder of the period, addressing his concern about ensuring his spouse's income. Option is incorrect because a life annuity without a period certain ends payments upon the annuitant's death, offering no additional security for his spouse. Option C is not the best option in this context. While a joint and survivor annuity could also support the spouse after his death, it typically reduces payments to the surviving spouse, which may not meet Mr. Anderson's desire for a steady income stream. Option D is incorrect, as a lump sum payout would not provide the structured income Mr. Anderson seeks for retirement, nor would it ensure income continuation for his spouse if he dies. Question 4. Which of the following statements about a guaranteed minimum income benefit (GMIB) rider on a variable annuity is correct? A. The GMIB guarantees the annuitant's principal value regardless of market performance as long as the annuitant does not make any withdrawals. B. The GMIB provides a minimum level of income in retirement based on the initial premium or a stepped-up value regardless of investment performance. C. The GMIB allows the annuitant to make tax-free withdrawals up to a certain percentage of the annuity's balance each year. D. The GMIB eliminates all market risk by locking in a fixed income for life without needing to annuitize the contract. Answer. B. Explanation. Option B is correct. The GMIB rider on a variable annuity guarantees a minimum income stream at retirement based on either the initial investment or a stepped-up value, even if the market performs poorly. This rider requires the annuitant to annuitize the contract to receive the minimum guaranteed income. Option is incorrect because GMIB does not guarantee principal value but instead guarantees a minimum income if certain conditions are met, usually after a holding period. Option C is incorrect. The GMIB does not involve tax-free withdrawals but instead provides a minimum income stream at retirement. Option D is misleading. While GMIB provides some protection against market volatility, it doesn't eliminate all risk as the income is dependent on the annuitant electing to annuitize the contract. Question 5. Which of the following best describes the tax treatment of early withdrawals from a non-qualified annuity before age 591 where the entire withdrawal amount is subject to ordinary income tax and a 10% IRS penalty on both principal and earnings? B. Only the earnings portion of the withdrawal is subject to ordinary income tax and a 10% IRS penalty, while the principal portion remains tax-free. C. The entire withdrawal is subject to capital gains tax, but not the 10% IRS penalty since annuities are tax-deferred. D. Withdrawals from a non-qualified annuity are completely tax-free if used for medical expenses or higher education. Answer. B. Explanation. Option B is correct. Withdrawals from non-qualified annuities are taxed on a last-in first-out LIFO basis, meaning the earnings which are tax-deferred are withdrawn first. Earnings are subject to both ordinary income tax and a 10% IRS penalty if withdrawn before age 591. Option A is incorrect, as only the earnings are taxed and penalized, not the principal, which was funded with after-tax dollars. Option C is incorrect. Annuity earnings are taxed as ordinary income, not as capital gains. Option D is incorrect. Annuities do not have special tax-free withdrawal provisions for medical expenses or education costs, unlike certain retirement accounts. Question 6. Scenario-based. Mr. Reynolds is a 66-year-old retiree who owns a fixed annuity. He is concerned about potential inflation eroding his purchasing power over time. His financial advisor recommends having a rider that adjusts his annuity payments to increase annually with inflation. What type of rider would best address Mr. Reynolds' concern? A. Guaranteed lifetime withdrawal benefit of a rider. B. Cost of living adjustment COLA rider. C. Death benefit rider. D. Period certain rider. Answer. B. Explanation. Option B is correct. A cost of living adjustment COLA rider increases annuity payments periodically to help offset inflation, addressing Mr. Reynolds' concern about maintaining purchasing power. Option is incorrect. A GLWB rider guarantees a lifetime income stream regardless of account balance, but it does not adjust payments based on inflation. Option C is incorrect. A death benefit rider ensures a benefit for the beneficiary if the annuitant passes away but doesn't help with inflation adjustments. Option D is incorrect. A period certain rider specifies a minimum payment period but does not address inflation or increase payments over time. Question 7. In Arizona, if an annuity replacement is being considered, which of the following must the financial advisor provide to ensure compliance with Arizona's suitability standards? A. A waiver of the free look period for all replacements to expedite the process. B. Disclosure of all fees associated with both the new annuity and the replaced annuity, along with a comparison of benefits and risks. C. Only the benefits of the new annuity product, as the previous product is irrelevant to the replacement decision. D. A statement guaranteeing a 10% minimum return on the new annuity product. Answer. B. Explanation. Option B is correct. Arizona's replacement regulations require comparison of fees, benefits, and risks between the existing and proposed annuity products. This ensures the client can make an informed decision and understand the suitability of the new product. Option A is incorrect because the free look period is an essential consumer protection, allowing clients to review the product and decide if it meets their needs. Option C is incorrect, as understanding the pros and cons of both the current and proposed products is critical in ensuring suitability. Option D is incorrect and misleading. Guarantees of returns, especially at a fixed high rate, are typically prohibited and unrealistic in annuity products, especially if market risks are involved. Question 8. Which of the following best describes the concept of a tax deferral within the context of an annuity? A. Taxes on earnings within the annuity are only due when the annuity is transferred to a new insurer. B. Taxes on earnings are deferred until withdrawals are made or the annuity is converted to a payout stream. C. Earnings within an annuity are never taxed due to the annuity's unique tax structure. D. Taxes are deferred only on qualified annuities, while non-qualified annuities are taxed annually on earnings. Answer. B. Explanation. Option B is correct. In both qualified and non-qualified annuities, taxes on the earnings are deferred, meaning taxes are not due until withdrawals are made or the annuity ends as the payout phase. Option is incorrect because tax deferral does not end when an annuity is transferred, it ends upon distribution. Option C is incorrect. Annuity earnings are taxable upon withdrawal, they are only deferred during the accumulation period. Option D is incorrect. Non-qualified annuities also benefit from tax deferral, meaning earnings are taxed only at withdrawal, not annually. Question 9. An individual purchases an indexed annuity with a participation rate of 80% and a cap of 10% per year. If the selected index gains 12% over a year, what would be the credited interest to the annuity? A. 9.6%, B. 10%, C. 12%, D. 8%. Answer. B. Explanation. Option B is correct. With a cap of 10%, the annuity's interest credit is limited to this amount, regardless of higher index performance. The participation rate, 80%, means the annuity would receive 80% of the index's return, which would be 9.6%, 80% of 12%. However, since this amount exceeds the cap, the final credited interest is capped at 10%. Option is incorrect because, although 80% of the 12% return would be 9.6%, the cap limits the final interest credit to 10%. Option C is incorrect as the 12% index gain is subject to both the participation rate and cap. Option D is incorrect. 8% is unrelated to either the participation rate calculation or the cap. Question 10. Which of the following best describes a joint and survivor annuity? A. An annuity that provides payments to two people with equal payouts until the first annuitant dies, at which point payments stop. B. An annuity that provides lifetime income to the annuitant and upon death continues payments to a surviving spouse at a reduced or same amount. C. An annuity that guarantees both principal and interest payments until the death of both annuitants, after which payments cease. D. An annuity where payments increase if one annuitant passes away, providing additional benefits to the survivor. Answer. B. Explanation. Option B is correct. A joint and survivor annuity continues to make payments to a surviving spouse after the death of the primary annuitant, either at the same amount or a reduced rate depending on the annuity terms. Option is incorrect, as a joint and survivor annuity does not cease payments upon the death of the first annuitant. Option C is misleading. A joint and survivor annuity's primary feature is the continuation of payments to a second person, not a principal guarantee. Option D is incorrect because payments do not typically increase upon the first death, and they remain the same or decrease based on the annuity agreement. Question 11. Which of the following best describes the free look period in an annuity contract? A. A time during which the policyholder can cancel the contract and receive a full refund, no questions asked. B. A period during which the annuity's interest rate can be adjusted without penalty. C. A time when the annuity policyholder can review the contract and cancel it for a full refund of premiums, less any charges. D. A 30-day period where the annuity contract's performance is guaranteed to meet a minimum return. Answer. C. Explanation. Option C is correct. The free look period allows the policyholder to review the terms of the annuity contract after signing it. If the policyholder decides to cancel, they can get a full refund of the premiums paid minus any charges. Option A is misleading because while the policyholder can cancel, they are refunded the premiums minus any charges, not a full refund. Option B is incorrect because the free look period does not allow for interest rate adjustments, it's a cancellation period. Option D is incorrect as the free look does not guarantee returns during this period, it's simply for cancellation. Question 12. Which of the following is a primary advantage of an annuity with a fixed interest rate over one with a variable interest rate? A. The annuity's value will never decrease. B. The annuity is more likely to outperform inflation. C. The interest rate is predictable and guaranteed. D. The annuity provides higher returns in times of market volatility. Answer: C. Explanation. Option C is correct. An annuity with a fixed interest rate provides predictable and guaranteed returns regardless of market conditions. Option A is incorrect. Although fixed-rate annuities offer guaranteed returns, they may still experience inflationary erosion. Option B is incorrect. Fixed annuities are not designed to outperform inflation, unlike variable annuities that may offer more growth potential. Option D is incorrect. Fixed annuities do not react to market conditions, so they do not offer higher returns during market volatility. Question 13, scenario-based MS. Taylor is considering purchasing an annuity with a 10-year certain period. If she dies before the 10 years have elapsed, what will happen to her payments? A. Payments will stop and the principal will be forfeited. B. Payments will continue to her beneficiary for the remaining term of the 10 years. C. Payments will continue indefinitely to her beneficiary. D. Payments would increase to make up for the loss of MS. Taylor's life. Answer: B. Explanation. Option B is correct. In a 10-year certain annuity, if the annuitant, MS, Taylor, dies before the end of the 10-year period, the payments continue to her beneficiary for the remaining term. Option A is incorrect. The payments do not stop unless the annuity is a life-only contract, which is not the case here. Option C is incorrect. Payments are made only for the duration of the certain period, not indefinitely. Option D is incorrect. There is no provision in a certain period annuity to increase payments after death to compensate for the loss of life. Question 14. Which of the following riders provides protection against a policyholder's longevity risk, ensuring that they will not outlive their income stream? A. Guaranteed lifetime withdrawal benefit. B. Cost of living adjustment COLA rider. C. Death benefit rider. D. Return of premium rider. Answer: A. Explanation. Option A is correct. A guaranteed lifetime withdrawal benefit rider guarantees the policyholder a steady income stream for life, even if the annuity's account balance is exhausted. Option B is incorrect. A COLA rider adjusts the annuity payments for inflation, but it does not guarantee income for life. Option C is incorrect. A death benefit rider provides a benefit to the beneficiary if the annuitant dies, but doesn't address income longevity. Option D is incorrect. A return of premium rider refunds premiums to the beneficiary or annuitant upon death, but doesn't provide lifetime income. Question 15. What is the key difference between an immediate annuity and a deferred annuity? The immediate annuities begin payouts immediately, while deferred annuities have a waiting period before payouts begin. B. Deferred annuities provide guaranteed payouts immediately, while immediate annuities do not. C. Immediate annuities have a fixed interest rate, while deferred annuities offer variable interest rates. D. Deferred annuities provide income during retirement, while immediate annuities provide income during the accumulation phase. Answer A. Explanation. Option A is correct. Immediate annuities start payouts immediately after the contract is purchased, while deferred annuities have an accumulation phase before payouts begin at a later date. Option B is incorrect. Immediate annuities do not guarantee immediate payouts. In all cases, there are variable immediate annuities too. Option C is incorrect. Both immediate and deferred annuities can have either fixed or variable interest rates. Option D is incorrect. Deferred annuities accumulate value before paying out, while immediate annuities begin paying income almost immediately. Question 16. What is a key advantage of a variable annuity over a fixed annuity? A. Variable annuities offer guaranteed returns, while fixed annuities do not. B. Variable annuities provide potential for higher returns by linking payments to the performance of underlying investment portfolios. C. Variable annuities are less subject to market risk compared to fixed annuities. D. Variable annuities have a fixed interest rate that is guaranteed for life. Answer B. Explanation. Option B is correct. A key advantage of variable annuities is that they offer the potential for higher returns because their payouts are linked to the performance of investment options selected by the annuitant, such as stocks and bonds. Option is incorrect. Fixed annuities provide guaranteed returns, whereas variable annuities do not. Option C is incorrect. Variable annuities are subject to market risk, unlike fixed annuities, which offer a guaranteed return. Option D is incorrect. Variable annuities do not have a fixed interest rate, but rather depend on the performance of underlying investments. Question 17, scenario-based. Mr. Jacobs is 58 years old and plans to retire in 2 years. He is considering a fixed deferred annuity for his retirement savings. What tax advantage does this annuity offer during the accumulation phase? A. The principal is taxed each year and the interest grows tax-free. B. Taxes on earnings are deferred until withdrawal, allowing for tax-deferred growth. C. The entire annuity grows tax-free, with no taxes due at any time. D. The principal grows tax-free, but earnings are taxed upon withdrawal. Answer B. Explanation. Option B is correct. In a fixed deferred annuity, the earnings grow on a tax-deferred basis, meaning taxes are paid only when withdrawals are made in retirement, allowing the annuity to accumulate value more efficiently. Option A is incorrect because the principal is not taxed annually, only the earnings are taxed when withdrawn. Option C is incorrect because only the earnings are tax-deferred, not the entire annuity. Option D is incorrect because both principal and earnings are tax-deferred until withdrawal. Question 18. What is the primary purpose of the 1035 exchange for annuities? A. To allow the annuitant to transfer funds to a new annuity without triggering taxable events. B. To guarantee higher payouts in the new annuity. C. To convert a variable annuity to a fixed annuity without incurring penalties. D. To allow tax-free withdrawals of earnings from one annuity to another. Answer A. Explanation. Option A is correct. A 1035 exchange allows the transfer of funds from one annuity to another without incurring taxes as long as certain conditions are met. This helps an annuitant avoid tax penalties when changing annuity contracts. Option B is incorrect. While a 1035 exchange may result in different terms or benefits, it does not guarantee higher payouts. Option C is incorrect. A 1035 exchange can apply to any type of annuity replacement, but it does not guarantee converting to a fixed annuity. Option D is incorrect because the 1035 exchange refers to the transfer of funds, not tax-free withdrawals. Question 19. In which of the following situations might a fixed indexed annuity FIA be more appropriate than a variable annuity? A. The client is seeking higher growth potential and is willing to accept more risk in exchange for potential returns. B. The client prefers a guaranteed minimum income with some exposure to market performance, but without the full risk of market fluctuations. C. The client is looking for a fixed return over the life of the annuity with no exposure to market risks. D. The client desires an annuity with high risk and the potential for a larger payout based on stock market performance. Answer B. Explanation. Option B is correct. Fixed indexed annuities FIAs offer a balance between market exposure and protection from market downturns. They provide some potential for growth tighter market index, but with limits on how much of the market's upside is captured. They do not expose the client to the full risk of market volatility like variable annuities. Vast do, making them a good choice for those seeking a more stable income with some opportunity for growth. Option A is incorrect. While FIAs provide some market exposure, they do not offer the same growth potential as VAS, which can fluctuate directly with market performance. Option C is incorrect. A fixed return without market exposure is typically offered by a fixed annuity, not an FIA, which still involves some market linkages. Option D is incorrect. FIs do not have the same high-risk potential as VAS, which are tied directly to market investments. Question 20. Which of the following is a typical feature of a rider that offers a guaranteed minimum income benefit (GMIB) on an annuity? A. It guarantees a specific payout for life regardless of the performance of the underlying investments. B. It ensures that the annuitant will never lose money regardless of the market performance. C. It allows the policyholder to access funds without any withdrawal penalty before retirement. D. It guarantees a minimum level of income based on a predetermined formula even if the account value is insufficient to support withdrawals. Answer D. Explanation. Option D is correct. A guaranteed minimum income benefit (GMIB) rider ensures the annuitant receives a minimum level of income for life based on a predetermined formula even if the account value is insufficient to support the level of income. This rider provides security that the annuitant will not outlive their income. Option A is incorrect. GMIBs do not guarantee specific payouts for life regardless of the account value. They guarantee minimum income based on the terms of the rider. Option B is incorrect. While GMIBs provide income guarantees, they do not prevent the annuitant from losing money on the underlying investments. Option C is incorrect. GMIBs are focused on guaranteed income rather than penalty-free withdrawals, which are not typical features of GMIBs. Question 21. Which of the following statements is true regarding the tax treatment of annuities? A. Withdrawals from a non-qualified annuity are tax-free as long as the annuitant is over the age of 591 wo. B. Contributions to an annuity are tax-deductible in the year they are made. C. The earnings on a tax-deferred annuity are taxed as ordinary income when withdrawn. D. Annuities are taxed at a flat rate regardless of income level. Answer C. Explanation. Option C is correct. The earnings on a tax-deferred annuity are taxed as ordinary income when withdrawn. The principal is not taxed, but any interest or gains are subject to income tax. Option A is incorrect. Withdrawals from non-qualified annuities are taxed on a last-in, first-out LIFO basis, meaning earnings are taxed first and there is no automatic exemption for people over age 591 wo. Option B is incorrect. Contributions to non-qualified annuities are not tax-deductible. Only qualified annuities e.g., as in retirement accounts, allow tax-deferred contributions. Option D is incorrect. Annuities are not taxed at a flat rate. They are taxed based on the taxpayer's ordinary income tax bracket. Question 22. Which of the following is a common characteristic of both fixed annuities and variable annuities? A. Both provide guaranteed lifetime income regardless of market conditions. B. Both allow the annuitant to choose from a wide range of investment options. C. Both can offer death benefits to beneficiaries. D. Both are subject to the same level of risk as the stock market. Answer C. Explanation. Option C is correct. Both fixed annuities and variable annuities can offer death benefits where the beneficiary receives a payout upon the annuitant's death are often at least equal to the original principal or some minimum value. Option is incorrect. Only fixed annuities provide a guaranteed income, whereas variable annuities depend on market performance and do not guarantee lifetime income unless a specific rider is attached. Option B is incorrect. While variable annuities allow the annuitant to choose from various investment options, fixed annuities do not offer such choices. Option D is incorrect. Variable annuities are subject to market risk while fixed annuities are not. Question 23. In a deferred annuity, what occurs during the accumulation phase? A. The annuitant receives regular income payments from the annuity. B. The annuity's value grows through the reinvestment of earnings and taxes are deferred until withdrawals begin. C. The principal value of the annuity is guaranteed by the insurer regardless of market performance. D. The annuitant is allowed to make unlimited withdrawals without any penalty. Answer B. Explanation. Option B is correct. During the accumulation phase of a deferred annuity, the value of the annuity grows as earnings are reinvested and taxes are deferred until withdrawals begin, typically at retirement. Option A is incorrect. Income payments are not made during the accumulation phase. They begin once the annuity enters the payout phase. Option C is incorrect. While some annuities guarantee a minimum return, this is not universally true during the accumulation phase, especially for variable annuities. Option D is incorrect. Withdrawals during the accumulation phase may be subject to penalties, particularly before the age of 591 wo. Question 24. Which of the following best describes an immediate annuity? A. An annuity that begins paying income immediately after purchase based on the annuitant's life expectancy. B. An annuity that allows the annuitant to choose their payout start date and investment strategy. C. An annuity that accumulates interest over time and starts paying income several years after purchase. D. An annuity that provides tax-free income to the annuitant. Answer A. Explanation. Option A is correct. An immediate annuity begins making income payments immediately after purchase, typically on a monthly or annual basis, and is often based on the annuitant's life expectancy. Option B is incorrect. Immediate annuities do not allow the annuitant to choose the payout start date. They begin payments immediately. Option C is incorrect. This describes a deferred annuity, not an immediate annuity. Option D is incorrect. Annuities do not provide tax-free income and the income is typically subject to taxes. Question 25. What is the main advantage of a living benefit rider attached to an annuity? A. It guarantees the annuitant's premium will be refunded in the event of death. B. It provides a minimum income regardless of how the annuity's underlying investments perform. C. It offers a death benefit that is paid out to the annuitant's beneficiaries. D. It guarantees the annuitant will receive a fixed return for the duration of the annuity contract. Answer B. Explanation. Option B is correct. A living benefit rider guarantees that the annuitant will receive a minimum income regardless of how the annuity's underlying investments perform. This can provide security if the annuity's value decreases. Option A is incorrect. Living benefit riders do not offer death benefits, so that's typically a separate rider. Option C is incorrect. Living benefit riders are focused on income, not death benefits. Option D is incorrect. Fixed returns are typically associated with fixed annuities, not living benefit riders, which are more focused on income guarantees. These questions should help provide deeper insights into annuities and their various types and riders. Question 26. What is a primary difference between a fixed annuity and a variable annuity? A. Fixed annuities provide returns based on the performance of a stock market index, while variable annuities offer guaranteed returns. B. Fixed annuities offer a guaranteed return, while variable annuities provide returns that depend on the performance of the underlying investments. C. Variable annuities provide a fixed income for the duration of the annuity, while fixed annuities offer a fluctuating income based on market performance. D. Fixed annuities are typically designed for short-term savings, while variable annuities are only suitable for retirement. Answer B. Explanation. Option B is correct. Fixed annuities provide a guaranteed return, typically offering a stable income, while variable annuities have returns that depend on the performance of the underlying investment options chosen by the annuitant. Option A is incorrect. Fixed annuities are not linked to the stock market, and variable annuities do not guarantee returns. Option C is incorrect. Fixed annuities do not fluctuate based on market performance, and they provide a guaranteed income. Option D is incorrect. Fixed annuities are designed for long-term savings, just like variable annuities, which are most commonly used for retirement. Question 27. What does the term living benefit in an annuity typically refer to? A. A rider that provides the annuitant with a lump sum payout if they live beyond a certain age. B. A guaranteed minimum level of income the annuitant can receive during their lifetime, regardless of market performance. C. A benefit that allows the annuitant to withdraw the full value of their annuity without penalty before retirement. D. A policy provision that allows the annuitant to borrow against the value of their annuity at low interest rates. Answer B. Explanation. Option B is correct. A living benefit rider guarantees that the annuitant will receive a minimum level of income during their lifetime, regardless of the performance of the annuity's underlying investments. Option A is incorrect. Living benefits do not involve a lump sum payout. If the annuitant lives past a certain age, they focus on ensuring a steady income stream. Option C is incorrect. Living benefits are related to income guarantees, not the ability to withdraw the full value of the annuity before retirement. Option D is incorrect. Living benefits are income guarantees, not loans against the value of the annuity. Question 28. Which of the following statements about qualified and non-qualified annuities is true? A. Qualified annuities are purchased with after-tax dollars, while non-qualified annuities are purchased with pre-tax dollars. B. Qualified annuities are subject to the same tax rules as 401(k) plans and IRAs, while non-qualified annuities are not. C. Non-qualified annuities allow for tax-deferred growth, while qualified annuities do not. D. Qualified annuities do not allow withdrawals before age 591 without penalties, while non-qualified annuities have no early withdrawal penalties. Answer B. Explanation. Option B is correct. Qualified annuities, like those purchased through an IRA or 401(k), are subject to the same tax rules as retirement accounts, including tax-deferred growth and penalty rules for early withdrawals. Non-qualified annuities are purchased with after-tax dollars but still offer tax-deferred growth. Option is incorrect. Qualified annuities are purchased with pre-tax dollars, while non-qualified annuities are purchased with after-tax dollars. Option C is incorrect. Both qualified and non-qualified annuities allow for tax-deferred growth, the difference lies in how the money is taxed when it is contributed. Option D is incorrect. Both types of annuities may have early withdrawal penalties, but qualified annuities typically face stricter IRS penalty rules. Question 29. Which of the following is a benefit of an income rider attached to an annuity? A. It guarantees that the annuitant can access their annuity principal at any time without penalties. B. It provides a guaranteed stream of income for the annuitant's lifetime, even if the annuity's account value decreases to zero. C. It offers tax-free income to the annuitant after the annuity has been held for at least 5 years. D. It allows the annuitant to select how the annuity funds are invested based on risk tolerance. Answer B. Explanation. Option B is correct. An income rider guarantees the annuitant a stream of income for their lifetime even if the account value of the annuity decreases to zero, providing financial security regardless of market performance. Option is incorrect. Income riders do not necessarily allow for penalty-free access to the principal, as this depends on the terms of the annuity and the specific rider. Option C is incorrect. While income riders provide a guaranteed income, they do not make the income tax-free. Option D is incorrect. Income riders do not allow the annuitant to select investment options. They are focused on providing guaranteed income. Question 30. Which of the following best describes a surrender charge on an annuity? A. A fee charged when the annuitant withdraws funds from the annuity during the surrender period. B. A tax imposed by the IRS on any annuity withdrawals over $10,000. C. A penalty for withdrawing funds before the age of 591 from a tax-deferred annuity. D. A fee for transferring the ownership of the annuity to another person. Answer A. Explanation. Option A is correct. A surrender charge is a fee imposed by the insurance company if the annuitant withdraws funds or cancels the annuity within a certain period, typically the first few years of the contract, known as the surrender period. Option B is incorrect. While withdrawals from an annuity may be subject to taxes, a surrender charge is not imposed by the IRS but by the insurance company. Option C is incorrect. While early withdrawals from a tax-deferred annuity may incur penalties, the surrender charge specifically refers to a fee for withdrawing funds during the surrender period. Option D is incorrect. A surrender charge is not associated with transferring ownership but with early withdrawals or cancellations of the annuity.